Hi guys, today we are having a very interesting conversation. Has been going on for as long as investing has been there. Concentration versus diversification, and there is definitely several aspects to it. And I was joined by Rufas. We delve into the difference between the two and how you can align it with your investment goals and objectives. Touched a bit on what is happening in Kenya in terms of investment opportunities or trends that has been there before. And of course, what to expect in the coming years or so. I hope it will be insightful and informative. Should you, of course, wish to, follow up, do not hesitate to comment. Enjoy the pod. Hey Rufas, how are you doing today?
I'm doing fine. Mm-hmm. How are you, Jesse?
We are doing okay. Yesterday, a company introduced me, and I decided to, take a bigger bite this year.
Let me guess before you say it.
Yes.
Palantir.
Definitely. That earnings report smashed the record off the roof.
Yeah.
And I got it at 17.
Yeah.
It's not an investment advice, of course. And that is a bigger pie than I did last year. I think last year it hit 30 and then it retraced back to even 16, 14 levels.
Yeah.
And I think we discussed about it sometime last year when we were doing AI.
Yeah.
I know there is a story about an investigation going around that they are yet to renew their new contracts with the DOD.
Yeah.
But, with the way they hit, and I think it was 10% rise yesterday before even markets open.
I think it was higher.
Yes, by closing at around 22. So that was a good jump and a good indicator of a positive 2024.
I saw the earnings report. They are calling themselves the Messi of AI.
Definitely.
No, I think Messi is done.
Yeah, but we're doing Messi of 2010. We're doing Messi of 2010. We're 2024, And why I'm excited about it is that at the value you get it at, and the topic we are going to discuss today, it is worth every pinch and salt to wait it out.
Yeah.
And see what happens in the near future.
Whenever I try to discuss individual stocks, especially to our listeners, I tend to think about it this way. Here's an interesting stock. Put it on your watch list. Putting the stock on your watch list, it means that you now consider that to be something of interest. Do further research on it, and then make an independent decision.
You'd be surprised. I put it on watch list in 2021. That was the time we started discussing it, when it was around $9 a share. I think it was just after the IPO or something.
That's when Warren Buffett basically bought the stock.
Exactly. And I think I want to test this experiment and see how it goes. I also bought in a huge way because we are yet to see the commercialization of AI. We have seen the reports, earnings report for Q4, Q3 last year.
Yeah.
AI was still the talk. Improvement, efficiency, learning about it was still the talk. But we have not seen, let's say, based on our book, let's say an example of Microsoft, you would see on their earnings report, Activision, the new acquisition, brought in this amount of billions of dollars on the, on the gaming side. You would see maybe office tools,
ad revenue.
Exactly. But on the AI aspect of it, whichever integration they use, there is no significant. You would say that this is what artificial intelligence drove in terms of either increasing revenue or even reducing costs. So I think this year, I know most companies have been doing we started with the stocks rising high to beat the 2020 COVID slump. Now, during the COVID 2020, most IT guys were on hot demand. You could say whatever price we have seen, they have been cutting down their labor force.
Yeah.
So I think this year is now to see if that is related with AI or not.
Well, for Palantir, it's the rawest you can get. The raw earnings is basically from selling an AI product.
Yeah.
Majorly to the US government.
Yeah. And definitely it is something that for the foreseeable future, want to watch out for. Coming into today's topic, diversification versus concentration. It is not a new topic, I know, for a lot of traders, whichever asset you invest in. But it is something I know it comes along the way of your trading journey. You get into something and you say, I'll trade gold. At some point, you remember last year I was majorly on US oil. I've never really been a concentration guy, but understanding the dynamics of different sectors of the market tends to do well with me in regards to finding good opportunities, be it short term or long term. On your side, I know you are a concentration, maxi.
Yeah.
What are some of the define it, and obviously, what are some of the aspects you look at in finding out where to concentrate your allocations?
Well, I'd like to begin by saying diversification versus concentration applies different across different people of different age groups as well as risk appetite. So, when you talk about diversification, this is concerning asset allocation. So, if you're trying to build a portfolio of, let's say, a certain size of funds, you want to make sure that the fund has sufficient growth that will help you reach your investment goals. But at the same time, you want to manage or mitigate risk so that if something bad happens, you don't lose everything.
Yeah.
So the way a lot of investors will approach this is by trying to distribute or to allocate the fund to different assets. This could be across different geographical regions, such that if, let's say, your assets are invested in Kenya, if something bad was to happen to the Kenyan economy, you'd be taking a big hit. But then, if you had some investments in Kenya, some investments in the US, Eurozone, Asia, then you will find that anytime, let's say, something is going down, then there is another country experiencing the exact opposite, and that kind of distributes the risks, protecting you from individual risk from an individual asset, sector, or market. So the goal of diversification majorly is to try and balance out the risk.
Okay.
So there's a lot of, I would say, literature around this, talking about how you can diversify your portfolio. And this has become a very consistent marketing tool, especially from investment advisors. You'll find some guys saying, put this percentage in bonds, put this percentage in stocks, put this in money market funds, and so on. So today we'll try and break it down, look at the ups, the downs of diversification, and try to compare these with having a concentrated portfolio.
Okay. Interesting that you brought the concept of, out of a pie, what percentages you allocate to different sectors.
Yeah.
I've been, studying and trying to follow what, the top investment companies in the world, like BlackRock or even KKR to Apollo and everything else, or even Berkshire Hathaway. There is always something stuck with how they go about it.
Yeah.
You'll find it's an all house
Yeah.
of investments.
Yeah.
But between, if you break down from the CEO or CIO
Yeah.
to the lower levels,
Yeah.
there is, an investment arm dealing specifically with equities.
Yeah.
There is a specific department or arm dealing specifically with treasury bonds, papers across the world,
Yeah.
or rather papers with the US. There is a specific arm dealing with the emerging market. There is the others which are doing mostly mergers and acquisition,
Yeah.
pre-listing, funding rounds and everything. There is, new emerging technologies like AI, Bitcoin, etc. Of course, as an individual, you cannot match the financial powers that these guys weigh,
Yeah.
and therefore they can hire the top, researchers on that area. But you notice that if you look at their general performance as a whole,
Yeah.
there is a picture there that is quite clear.
Yeah.
If this year real estate is down because people are being fired, the companies are downsizing, or there is just little demand to housing,
Yeah.
the housing department of the arm or the real estate arm of investment arm
Yeah.
will do break even or worse off.
Yeah.
But on another aspect, let's say emerging technology
Yeah.
that are invested in AI companies did like 300%, and therefore it pulls the weight for the other pair. To retail investor, what is the plan?
Well, I would say it's only a grave that you start digging from the top.
Okay.
For a majority of retail investors who are either beginning their journey or somewhere midway, you're trying to build a portfolio, let's say, that will help you achieve your financial goal, or cash flows, maybe a retirement fund, and so on. So you start small and then keep adding money to that investment. So if, let's say, you're starting with your savings, you have 200,000 shillings, let's say, saved in a bank or a SACCO or whatever, and you want to put these in the financial markets to achieve market-beating returns. So first things first, this person might consider, let me begin with this number of shares. So the client, say, goes to FX Pesa, sign ups, and let's say buys something like Tesla shares, not a recommendation. So once this client buys these shares, on the next purchase, they might decide, let me buy these other shares. Maybe he decides to go for Palantir. So bit by bit, this client keeps building a portfolio. So if you're just starting, I don't think diversification applies for you. So if you're really concerned about, let's say, risk, the downside risk to your initial investment, then in that case you might consider going for, let's say, a market benchmark. You might want to, let's say, bet on the entire US stock market, go and buy, let's say, SP 500 ETF. So for an investor who is really concerned about downside risks, let's say you are close to your retirement, you are 60, you want to have a fund that gives you some dividends after every year, you might want to consider being more diversified. So by betting, let's say, on the S&P 500, you're betting on the entire US stock market, and it has had some consistent returns over the years. So every 4 or 5 years, you might have, let's say, one down year, but the rest of the years will compensate. But then, for a person who is really looking at high growth portfolio, diversification doesn't apply. You're not looking for that 10, 13% from the S&P 500. So in that case, you might consider going for a more concentrated portfolio, and that exposes you to high risk but also high reward in case the investment you're going for is performing well.
Okay.
So in such a case, since it's high risk, high reward, in order to at least work out and minimize the risk you are taking, it requires a lot of effort. And if you're a young man, it doesn't take long for you to figure things out.
Yeah.
So you can literally dig into a company's book, look at its revenue segments, look at its history of earnings, new products, maybe even consume some of the company's products to experience them. Then dig to things like the Form 10K from the company. This is a document that shows the company's books as well as its performance extensively. It's deeper than the quarterly earnings report. So when you understand the company intimately, and then your projections show that it has the capacity to beat the overall market. In this case, I'm trying to think of a company versus the S&P 500.
Yeah.
Then in that case, you might consider going for a concentrated portfolio, betting that this company will do well.
Okay.
But then that doesn't imply you put 100% of your money in that stock. You might, let's say, distribute. An approach that I've seen do well for some of the investors I've interacted with is identifying a sector that has a high compounded annual growth rate. So once you identify, let's say you're looking at, let's say, cloud computing stocks. You have quite a number of companies that are doing this. So you analyze them and then you identify I would say the apex company in that sector. So you allocate some capital to that. Let's say you look at EVs. You find that there's quite a number of companies producing electric vehicles. You realize that the sector has a high growth, and then you do your analysis to identify the company that has the best potential to outbid the others. So in that case, you allocate some amount there, and as you look across different sectors, you might find yourself with a company in the, let's say, energy industry, cloud computing, AI, and so on. So with such a collection, you realize that in some cases, you might be overly exposed to, let's say, tech.
Okay.
So in order to balance out the risk, then you might find, let's say, a slow growth sector that will compensate in case the tech doesn't perform well.
Okay. Interesting that you mentioned that. I think we have started with the long-term investment plan. So that means anybody who is looking at least half an year at least to let's say 5-year plan.
Yeah.
Of course, in a CFD terms, it might mean maybe accumulating a couple of swaps here and there.
Yeah.
So that might be another factor to watch out for in terms of if the account can sustain it or you can find a way to exit it.
Well, the swaps are not really a big problem.
Yes.
If you are doing your investment analysis and you want to go into a leveraged position, then you should know that the cost of a swap, especially with FX Pesa, is an estimated 4% of your position.
Okay.
So if your company does anything above 4%, then you have completely covered. So that applies for 1 year.
Okay. No problem. Now, not to leave majority of Kenyan traders who are beginning. There is this aspect where you start with Euro USD, you realize, okay, I'm getting 60, 40 pips on a good day, 1,000 pips, regular 40, 60, on a good day, even up to 100 plus pips, yeah? Then you say, okay, I don't like this. I like the other side of it. Not because of the movement valuation, but rather of the pip value, or something like gold, or maybe something like oil, or something like maybe futures contract, UT 100. I see people concentrate on it, and there is this aspect where you look at the price action, and not to ignore, but rather sideline it. The fundamental aspect, the drivers of the indices, for example, of the drivers of these particular asset classes. I was like that at some point, and then last year I think I was following a lot of keenly on oil market. You realize that there is a lot of nuances that if you are trading it on a regular basis, you might miss out to what are the major factors. But if you are able to go into deeply, what are the decision plan for those who move and participate in this market in a significant way to drive price action? And that is when you realize, okay, so yes, EIA numbers, the reports that comes out to tell us what is the production rate, what is the storage rate and everything, has this impact. But there is the political angle of it, maybe, what is happening in US or Venezuela or the others. Now there is the other, economic angle, which is happening in Saudi Arabia, Bahrain, like we spoke last week with Said about, how they make their budget. Now you go to the production side, the demand on Chinese too. Of course, the oil in regards or correlated to their production. There are always these angles whereby you need to always look out for. So, as some of those focusing on the concentration, is it necessary for a trader, particular retail trader, on a daily or day trader, to focus on one particular asset or form a strategy whereby you will look at the charts, the candlesticks on a certain sector or asset class or currency set, and then use that approach across board, or or you just stick to one? If there is nothing clear because you prefer it, you stick to it.
Well, I think for a day trader, there are certain trade-offs and lessons to learn. First things first, if you are focused on, let's say, one or two pairs, you exclusively trade Euro USD, Pound USD, that reasonably lowers the amount of work that you have to put into research. So you're researching the countries. So you're following the European Central Bank, you're following the European economy, you're following the UK economy, the Bank of England, you're following the Federal Reserve, and at the same time, you're following the performance of the US economy. So as soon as you study that extensively, you're able to exploit differences or policy shifts that might drive trends in those two currency pairs.
Okay.
So in that case, the amount of work that you have to put in basically is focused on a small number of assets. And as a result, you're able to master those trends and literally just be in the zone. Even if you're asleep, you're somewhere taking lunch, you know exactly how the chart looks like, where it's headed, and probably where to identify your opportunities. But then, here's the downside to this. There are some times when certain asset classes will be trading sideways. And this is moments or periods of indecision. So there are literally weeks when Pound USD, Euro USD will be moving sideways, and you don't have any major opportunities that can give you enough opportunities.
Yeah.
So for you, you're not loyal to the market, you're loyal to your account. So your goal as a trader is to make money. So if, let's say, pound USD and euro USD are just moving sideways, and you're just sitting on your hands saying, oh, the markets are not moving, I'm not doing anything until I start seeing strong trends, then you are basically losing out if we compare you to another trader who considers themselves as volatility hunters. So for any trader out there, we both know that for you to make money, there must be volatility in the market. Prices must be moving in a strong way in a certain direction. That can be upwards, downwards, but sideways is not very effective for us. So if you consider yourself as a volatility hunter, then you might expand your possibilities. So instead of just focusing on two assets, maybe do some form of wider analysis of the markets to identify where the money is moving. So if a lot of investors are moving their money, let's say to Chinese indices, then that's what you are trading. For instance, yesterday, I scanned all the markets and I couldn't find any opportunities in currencies, in gold, in oil, in indices.
Yeah.
But then looking at Chinese indices, there was some good volatility. So I studied that market, try and understand what's currently happening, and then I identified some good opportunities. So it makes more sense to have a wider net where if you're a fisherman and you're fishing in the Indian Ocean, you're not just focused on Lamu. If there's no fish in Lamu, you want to move to a different area where there's fish.
Yeah.
But then if you just sit by and say, there's no fish, but fish normally comes in, let's say, March, so you sit on your hands for the entire February, it's not very productive.
Yeah, I think you make a very good point, and I like the statement. You always you don't loyal to the charts.
Yeah.
You are loyal to your money.
Yes.
I like to say, I like to put it this way: there is nothing wrong with withdrawing your money, because there is no honor in growing your account from, let's say, $100 to $10,000, and then blowing it up and the only thing you have is a screenshot.
Well, I don't think that way.
Me, I prefer to, when I make money,
Yeah.
I take some portion of it. Not that I go and spend it.
Yeah.
You allocate it somewhere else,
Yeah.
so that you know, okay, I did a good work today. I enter the market, with your strategy. You have achieved the goal for the day or the week and everything. And therefore,
Yeah.
you are taking your due interest. Not that you are, I think for me, it works for psychology purposes.
Yeah.
Okay, I made this amount of money,
Yeah.
and now, like I said, it's a cash flow thing. So you put it now to the other investment vehicle that you have, that you don't necessarily, it is not a liquid vehicle.
Yeah.
It is something to look at maybe 6 months' time.
Well, I would say I've interacted with a lot of traders, and I've seen different traders having different approaches to this.
Okay.
So the simple idea is to have a goal. So anytime you're trading, have a goal. So I've met some traders who will just trade an account just to fuel their car.
Excellent.
That's it. They just trade. As long as they make profit, they know this is enough to get me another full tank. And once they make that withdrawal, the next goal is to work towards the next refill. I've seen traders who have a goal, let's say, to buy an asset. I want to buy a piece of land, make construction.
Or a Lamborghini.
Yeah. And in order for me to achieve this goal,
Yeah.
I need to work on this account for the next 1-2 years. So they will put everything in terms of discipline, risk management, and keep growing that account. And anytime they feel they are slowing down, they would add more money to that account and keep pushing it until they achieve that goal.
Interesting.
Then there are other traders who will have this dividend policy,
Yes.
that if I move this account from this point to this point, then I'm going to withdraw this amount of dividends,
Yeah.
and then reinvest the profits to the account. In this way, they keep on building the account, but they are still benefiting from withdrawals. So I think it's an open discussion where you have to reason and look at what you're trying to achieve with that account.
Yeah. Before I leave the 2 points that you have mentioned, I think I'd like to pass some piece of information. Number one, I think what we are getting is that for you to diversify, it means perhaps, or to diversify, it means maybe you are a full-time trader, so you have all the time.
Yeah.
You're just trying to look at which one will give you the best performance in the day.
Yeah.
But for focus or concentrated traders, you're maybe a doctor, a lawyer, so you do not have all the time to do your main hustle and then do this. So you decide to allocate your focus on or study on a few segments of the economy that or markets that you would like to get into and just stick onto it. If I'm getting that correctly?
Yeah, that makes sense.
Exactly. Now, for those who are interested in understanding what you just said regarding the Chinese shares, I think it was just a breaking news. For context, we are recording on the 7th of February that their head regulator has been relieved of duties. And I think the Chinese market is really, going haywire. For those who are interested, if you go to your portal, your FX Pesa portal, those indices are in the CISD indices folder. So you can choose whether to get into the China 50 roll or the C shares or the Hong Kong 50 and everything. I think there is the futures contract and then there is a rolling indices. So you can look into that. There is some good volatility there and for good reason. Now that you've mentioned it, I think it is fairly obvious that European economy is more or less lull, and the Asian market is now the one to watch, for example.
Yes, the Asian market is currently at a 4-year low. I think the last time we saw the current prices was just before COVID.
Yes.
So I'm speaking about the China A50 cash index, the Hong Kong A50 index. But then this is different from Japan. The Nikkei 225 index is basically flirting with the all-time highs.
Okay.
So for China, we have seen the economy really struggling to recover. There was crackdown on tech stocks. We haven't heard of Jack Ma since the attempt to make the biggest IPO with one Ant Group.
Yeah.
So things have been really going down, and a lot of investors are now interested, mainly because the valuations are low, and there's that potential that we could be entering an age of easy money in China. And by age of easy money, focusing on a potential where in an attempt to push the economy into a recovery, the People's Bank of China might consider going for a lot of stimulus packages this year. They already started late last year. They have added their stimulus package this year in January, and they could be extending this, and they could also be considering cutting interest rates. So it's such an environment that creates a stock market rally, and we can reflect this with what we saw in the US just after COVID. So after COVID, we saw the US cutting interest rates to record lows around 0.1%, and then employing massive stimulus, which created a very strong bull market in the equities.
Yeah.
So if something similar is about to happen to China, then I'm very interested. I want to look at the stocks, understand where they're headed, look at the indices, analyze, look at the economy, and potentially there could be some opportunities that investors are eyeing going forward in this year.
Interesting. I think it's only fair to say we have had almost 2 years of all-time highs in the equities indices in the other side of the seaboard. So I think it will be very interesting to watch that market for one particular reason. The obvious reason, it is the second largest economy in the world.
Yes.
So you cannot really ignore a population of almost 1 billion people, an economy with trillions of dollars in GDP, and having a bear run, knowing very well that at some point on the other side, people will be cashing in their profits, will be having some correction, and then hopefully that cash will be allocated somewhere else.
Yeah, and of course, they're making big moves on the BRICS. Just adding more countries
Yes.
expands the direct markets that China will be able to sell directly.
Interesting. Now, to almost bring it home and we approach the end, Kenya is a place where you lack you get some good cash.
Yeah.
You want to park it somewhere, look for the cheapest piece of land next to a nearby or upcoming development coming by.
Yeah.
I think that is almost sort of a concentration, right?
Yeah.
Now, I was looking at a report recently from Haas Consult, and they were saying land in, the posh areas of Nairobi, Kileleshwa, Kilimani, and areas, has appreciated since 1994 by almost 400%, while the stock market has declined by 34%.
Yeah.
It has become very hard to pitch to Kenyans the idea of maybe in the capital markets you could make some returns, despite, the big players like Kimani, like,
Kimani Buffett.
Yes, and the others participating in that. is there a time where maybe, or is it that it is the economy or the psychology of people that put value to a certain asset class in the economy, or is the fear of the unknown, or it's maybe lack of proper information?
Well, I was doing some research earlier this week, and I compared the inflation rates in Kenya over the last 5 years.
Yeah.
So we have averaged around 5.5%, meaning that the value of the Kenya shilling has been depreciating by about 5.5% over the last 5 years. Or to frame it another way, the average prices of the basket of goods you buy every month have been increasing by about 5.5% each year for the last 5 years. So this means that if you just, let's say, locked your money into, let's say, below your mattress for the last 5 years, you would have been taking a very big hit in terms of purchasing power because the prices are going down, up, and the purchasing power of your money is going down. So this forces Kenyans to invest their money. The moment you sit on your money, you're not maintaining your purchasing power, so you're forced to invest. So what we have been seeing over the years is that a lot of Kenyans have explored different options. So you try and start a business, and if business conditions are bad, you close out. You try agriculture. If agriculture is not doing well, you end the business and so on.
Yeah.
So despite looking at smaller businesses that have really done well, a majority of businesses have been doing poorly. So Kenyans have also considered investing in the stock market. But then, if you look at the Kenyan stock market, if you isolate a few companies that have been carrying the Nairobi Securities Exchange, a majority of the stocks have been going down. So overall, if you look at the overall index for the Nairobi Securities Exchange, it has been going down since 2015. So every year, the index has just been losing and losing and losing. So if you just put your money, let's say you wanted some form of diversification, you bought the entire index, you'd be losing money every year. There are exemptions. Maybe someone who chose a concentrated portfolio went for something like Safaricom,
Williamson T.
yeah, a select number of banking
ABL,
stocks.
yeah.
Then you would be at a profit. Yeah.
I think that makes a very strong case for capital markets in Kenya is more of a concentrated base
Yes.
than diversification.
Yeah, if you decide to eat a toad, you eat the juiciest.
I think that is a clear one.
Yeah.
So the 34% is true, but I think at some point last year or the year before, we had Safaricom going to the at least late 40s, around early 50s per share.
Yeah.
And they still have maintained a very good record of paying dividends on time.
Yeah.
So that's a good case for a strong company,
Yeah.
at least for the foreseeable future, so long as we keep on buying or using M-Pesa.
Yeah. So what I've seen with Kenyans, after weighing all these options, they have also experienced, especially I would call them boomers. Boomers are the people who were born in the 80s.
Yes.
Yeah. You realize that for them, for any boomer that managed to buy, let's say, land in any of the now newly developed areas within the country, they enjoyed out of higher pricing from their pieces of land as a result of the developments that have happened in Kenya.
Yeah.
So during Kibaki and Uhuru era, there was a lot of infrastructure that spread out across the country. So mainly, if you look at things like Thika Road, you look at the Outer Ring Road, so anything that falls within the metropolitan area, there's the issue of devolution, counties moving to different areas of the country. So all land around those areas appreciated at a very fast pace. So these are the guys who would buy a piece of land for 30,000. Then a few years later, they sell for 5-10 million.
Of
But
which
then,
previous performance is not a guarantee of future performance.
yes. So this has created a culture where it's almost like a self-fulfilling prophecy, where anytime you buy a cheap land and you hold on to it for a couple of years, you sell at a profit, and this is synonymous with all other bull markets. So whenever there's a bull market, it gets to a point where it became purely, I would say, speculative, and nobody is considering the fundamentals.
Okay.
So if you told someone, let's say last year, that let's say the S&P 500 at some point will begin correcting, they wouldn't believe you. So since, let's say 2007 to 2008, Then Obama became president of the US. The S&P 500, the Nasdaq, the Dow Jones have all been rising. So that bull market has been consistent. And every time you try to tell someone don't invest in this, they won't believe you. So that has been backed with economic growth, the age of easy money, and that has really built the asset classes. But then all bull markets come to an end. So the way bull markets come to an end is not because prices reach a certain level and they start reversing. It's based on the fundamentals behind what's happening. So we are not seeing, let's say, infrastructure growing at the same rate it was growing in Kibaki and Uhuru era. The incomes of Kenyans are not rising at the same pace. So in terms of growth and business development, we are seeing the Kenyan economy really slow down. Access to, let's say, loans has really gone down as banks are now focused on lending more money to the government compared to the private sector. So anyone who is running, let's say, a private sector business, they can attest to this. There's a lot of economic challenges happening right now. So you'll realize that as long as the consumer is hurt, then overall demand goes down. And you'll find that, let's say you bought a piece of land at, let's say, $1 million a couple of years ago. You're looking to sell it at 5 million. It's the market price as at now, but there's no liquidity.
There is no buyer.
Nobody is buying that asset. So we are beginning to see that happening across board in the real estate sector. For instance, look around Nairobi, Westlands, Upper Hill. You'll find a lot of tall buildings with a lot of empty spaces, mainly because there's a lot of trends changing and business conditions are not as desirable as they were a few years ago.
Yeah, definitely. I think the bottom line is for the capital market itself to perform better, it all depends with what is the purchasing power of the people.
Yes.
If you cannot buy and spend as you wish, it means obviously those companies will not get proper revenue.
Yes. And now this is the downside of concentration. So if you had a very concentrated portfolio invested in real estate assets, let's say you bought out of pieces of land, commercial property, if now that sector is not doing well, then you're stuck there. So the risks of concentrating your portfolio in one market, if things start going bad, then you take a big hit.
Basically, do your home research well, and then get in at the convenient. Hopefully, also learn to get out at the best time. I think that's also very important.
Yes.
I think that's a good discussion, and definitely it will continue in the coming year with a lot of things changing, including the recent hike in Central Bank of Kenya interest rate to 13%. I guess that we might cover it in the next session. Any closing remarks for today, as we probably will meet the next time after Valentine's?
So for me, I think if you are really determined into getting above market returns, and when you talk about above market returns, when you consider, let's say, the US, the market return or the minimum rate of return you get is by just parking your money in the S&P 500. So if the S&P 500, let's say, had 12% performance last year or an average over the last couple of years, that is what you are looking to beat. You want to get a higher return than that. But then for the Kenyan market, I think the benchmark is the bonds. So if
20%.
if the bonds are giving 17, 18, 19, 20, if that's the benchmark, that if you are lazy, let's say you are running a pension fund, you just park your money in a Kenyan bond and that's the return you're expecting, then for a very hardworking Kenyan who is looking to take an extra risk, then the return has to be above that. So if you are really focused on getting above market returns, then you have to accept some level of risk. And the way you balance it is by doing further research, understanding what you're investing into, having an upper hand, mainly because you have more information than the other average investor.
Yeah, I think that sums it up pretty much. Should you have any question, do not hesitate to share your comments, be it on social media or the Bullish Banter socials page. Of course, for those who are interested in maybe getting started with trading, you can just click on the link on the bios, on the description. I think that should be enough for you to get a demo account for you to familiarize with which asset class or economy sector you might want to get into. I've been your host, Jesse. Have a wonderful day ahead. And happy Valentine's.
Now we have new social media handles for Bullish Banter. So make sure to follow us across all handles on X, as well as Instagram, TikTok, and so on.
Yeah.
And if you have any questions, post on those handles, and we will be responding to that live on the podcast.